Thank you so much, Azra. And hi, everyone. Thanks for joining this afternoon. And welcome back to some of those who joined, I think it was 3-4 weeks ago that we did something similar on the directors and officers insurance. So, yeah, today we want to talk about professional indemnity insurance, what it is, what to look out for. It's going to be a pretty similar format to our last deep dive session, if you were there, for directors and officers. So what I thought as a first starting point is to just really talk about the name of this insurance policy. I feel like there are a few other names out there and people get a little confused. So I just wanted to start off with that. So I personally call it professional indemnity. I think that's quite a common terminology in this part of the world. Sometimes you hear it also as professional liability. And in the US, often they call it errors and omissions insurance. And it basically all means the same thing. It's just so that you know there are 3 different terminology for it, but it's the same sort of policy. But in Singapore, it's mostly called professional indemnity, PI for short. So thought we'd just get straight into it and just really explain what is this insurance really all about, and why would you want to get it. It's really there because mistakes happen. Some insurance policies are there for, if you think about it, like a fire type of policy. That could be something that happens externally to you. It's something that's out of your control. But when we talk about a PI policy, this is really around errors and omissions or mistakes that may happen as part of doing business. And specifically for PI, it's really to protect your business when someone claims against you that the service or the product that you're providing caused them to have a financial loss. So it's usually in the form of a lawsuit or a claim like that, you know, the service that you were supposed to provide didn't work, it failed, and as a result, the clients lost money. And these sort of mistakes can happen, you know, mistakes anyway always happen. It could be within your control, or it could be a subcontractor, a consultant, another third party that you engage with to help you run your business or help you provide your services. And it could be that one of these third parties is actually the reason why there was an error or a mistake. But your clients don't know who your subcontractors are. They only know they have a contract with you. And so actually your company is on the hook for the error. So that's also something to think about, you know, in terms of how your business is set up, that it's not always, you can't always control everything within your team and what your employees do. It's also these other third parties that are involved in your overall business that may also slip up. Another reason why we have PI insurance is because technology moves faster and than regulation. And, you know, it's not always so black and white on who's liable for when things go wrong. So your PI policy is also really good just to cover your backside. You've got something there in case you're deemed liable for something that's gone wrong when actually maybe it wasn't. I get asked this question a lot. Well, if I have a contract in place with my client and it says when signing the contract or the terms and conditions that they waive all indemnity rights, all that kind of stuff. Yes, you can have all these great things written in a contract and signed, but this still does not prevent people from filing a lawsuit or a claim against you. So contracts can be as watertight as possible, but still people will claim. If they're out to get you, they'll be out to get you, and they can. And even though you're not at fault, you're kind of on the hook for all these legal costs. And so again, this is why what a professional indemnity policy is there for. By the way, if there are any questions, feel free to use the chat, the Q&A in there, and then we can kind of go through them towards the end. So that's what PI insurance is. Who exactly needs PI insurance? Because it's not every single business needs this policy. And I've divided into 3 groups that I think are most applicable for this sort of policy. So firstly, any sort of startup or company that sells tech-related services or products. So your SaaS companies, your fintechs, anyone that has, like a tech element to it where your customers are subscribing to the service. A lot of companies nowadays does AI and, big data and all this machine learning, and from that, your customers are using your product services and products to understand their businesses better or to create new products themselves. So they're relying on you as a SaaS company. So potentially, if something goes wrong with the algorithms, failure to actually deliver the service on time. Let's say you're an e-commerce platform and something's happened and now your customers no longer can sell on the platform because of an error. That's grounds also for a claim under this sort of policy. So that's kind of one group of companies you can think of, technology related. The middle bracket are any sort of company that provides advice, management consultants, your HR, recruiting kind of firms, even like corporate secretaries, PR consulting firms. So these firms are coming in to work closely with businesses to give them advice, consulting on what they should be doing. This is how you should restructure. This is what your strategy should be going forward for whatever. These guys, because of the element of advice that they're giving, is very much open to, okay, if the advice was incorrect and their clients lost money, they can be sued for that. The third one that I've pulled out for today at least is fitness companies. You could be a gym providing, or a personal trainer that's just working as a freelancer. You could be, or you're a fitness studio, you're an instructor, you're providing advice, you're showing people how to use the machines at the gym, how to do this particular movement. And again, if someone's hurt themselves as a result of that fitness instructor's advice, that could potentially be a claim as well. So these are 3 very broad buckets of companies. There are also much more specific products, PI products you can buy. So for example, for lawyers, there's like a specific wording for lawyers, or for architects, because you can imagine if an architect's designed a building incorrectly and then, the whole building collapses or whatever, that's also a PI claim. So the PI product can be very much tailor-made to many different types of industries and job types. What I'm pulling out today is what I think most of you who are on the call fall into one of these buckets, maybe two out of the 3 buckets. So it's really, there's always an element around advice, consulting, providing a service, and it's a professional service, and this is where PI really falls into place. Now I'm going to go through what a typical policy covers. I mentioned before, claims usually come in the format of like litigation, so like lawsuits. So this policy, and which is also potentially very expensive, right? What a PI policy covers is those legal costs. So the cost to hire a lawyer to defend you, and if it goes to court, the settlement costs that the judge rules, or if it goes to mediation, whatever the settlement amount is. So that's really what the PI policy is in place for. It's also there for official investigations. So think of MAS in Singapore, the financial regulator. If they think if you're a fintech and you've done something that doesn't seem right, especially in terms of your professional service, they might come in and do an investigation on you. Maybe there's a fine or a penalty involved, and that insurance is really there to cover these sort of costs that might occur. Subcontractors, consultants, and agents. So what I mentioned before on one of my first slides, being that mistakes can happen that are out of your control, and it could be these third parties. A PI policy generally extends to cover these third parties. I've talked a lot about you getting a claim because your client's lost, has suffered a financial loss. And what I have on these slides, these sub-limits, these are, I suppose, kind of examples, if you like, of where they might have lost money. So maybe they've claimed that you've stolen their intellectual property, you've copied them on something, on the type of service or whatever. They might claim that, and that's what a PI policy can cover. It can cover for cyber claims. So cyber in respect of your liability as a company of protecting third-party data. If you accidentally leak, if there's a breach and you are hacked, or you didn't have the right controls in place and you leaked your client's data, they might come to you and sue you for that. And that could be covered under a PI policy because that was an error or an omission on your side as part of the professional service that you provide to your customers. So, so there is, in some policies, not in all PI policies, but in some, there is an element of cyber coverage for the legal and defense costs. Defamation, if your clients claim that in however you're doing your business, you've defamed them, they might claim against you for that, potentially covered also under a PI policy. If you've lost your client's data, and then there's a cost involved to restore it, kind of similar to the cyber, but you know, if you have documents of your clients, so let's say you're a management consulting company and you've got access to they give you access to, I don't know, all these past financial statements or business strategy documents, and you accidentally lose it and they sue you for that, that can potentially be covered under this policy as well. And then some policies provide what I call extra covers. One of them is being mitigation costs. This is the cost that you would pay to a third party to help mitigate it. So if someone's coming to you and saying, oh, I'm really upset with what you've done. Let's say you've lost my data or something, or you've, maybe it's a cyber related thing that you've had a breach and they're threatening to sue you. With prior approval from an insurer, the insurer, you might have mitigation costs which you pay to a third party. So to an incident response type of company to help recover the data already. That could be part of it. So it's basically in the insurer's interest to lower legal costs. They don't want things to go to court because, you know, the legal fees really ramp up and settlement costs could be quite high if you're liable. So it's in the insurer's interest that you as an insured, like the policy holder, also can try and mitigate the costs. So some insurers include this, which is great. And it just needs pre-approval from the insurer before you go spend that money with that third-party provider. So that's something nice as an extra. Another extra is PR expenses. So if you do get a claim and it just doesn't look great in the media, you want to do some damage control, you want to work with a PR firm to help, you know, rebuild your image and your brand and your reputation, most PI policies include a sublimit that you can be used towards that. So those are the general coverages of a policy for PI. And then in terms of exclusions, this is the first thing I've got there is criminal or deliberate acts. And this is across, all sorts of different lines of insurance. I mean, I feel like it's a given, but I think we should state it. Anything deliberate by the insured is excluded. PI does not include bodily injury claims. So I talked about that first slide, PI policies there in case your clients suffer financial loss. Bodily injury claims are excluded unless it's really a direct result of your type of business. And this goes back to that third bucket of companies that fall into a need for PI, and that's like fitness instructors, gyms. Their nature of their business is helping people work out, and bodily injury is going to be, if something goes wrong in terms of the advice that the fitness instructors are giving, it's most likely a bodily injury claim that will result from it. And so that's not excluded for gyms and fitness centers, but let's say a fintech company, an e-commerce, a bodily injury claim, that's not going to fit. No one's going to be physically hurt because of advice you've given, basically. So that's excluded. Ongoing litigation, this is anyway given with all sorts of these sort of insurance policies. If you're aware of ongoing, if you already have a lawsuit going on, and if you're aware of something that's already coming up, that's going to be excluded. Product liability is also excluded. That is when there's a physical product and that explodes, hurts somebody, or it's a food that maybe you're a food manufacturing company and someone eats it and hurts themselves or gets sick. That is product liability. So that's around the actual product design, manufacturing, also like the labeling of a product. So it's very, very different to professional indemnity. And then property damage claims, those are excluded as well. So if you're, that's mostly again, going back to this product. And if something explodes and makes a hole in the window or the wall, that's a property damage claim. That's excluded from a PI policy. So hopefully this is a helpful little slide to show you what covers, what's generally covered under PI and what are the common exclusions. The next slide is all around when is the best time to take out this policy. So we really think once you've launched, once you've really launched your products and your service in the market, basically you're open to, you're out in the market, people are aware of you, they're engaging with you, then, there's always a risk there. What we see a lot of the times, and maybe some of you already experienced this, is that when you want to engage with enterprise clients, they often request that you have a policy in place. They want to make sure that you're protected so that if something goes wrong, they can actually claim back from you. And a lot of the time, these enterprise clients will say, you need a 1 million liability, 1 million limit of a PI policy in place, or sometimes we see ridiculous limits of like 5 million or something for such a small like SaaS company. But it seems quite often that in order to get your contracts in place with these clients, you need to put a PI policy together. And this is mostly we see on the technology side, so technology startup side. Another time where you might want to consider this policy is when you're fundraising. It signals to your investors that you understand your risks, you know what you're doing, that you've got things in order and you're kind of responsible and you know what you're doing. So I would say these are the main kind of 3 times that you would need it. What we find, a lot of people come to us, to Anapi, mostly for that second point when they've got an enterprise client and they have to scramble for it. And it's usually the last thing they need to get in place to sign this contract with their client. And they come running to us saying, hey, can you help us? We need this policy in place ASAP in order for us to do business. So it's an interesting spin of thinking about how insurance can actually help you with business development or growing your business, because if you don't have it in place, you can't get these contracts, and like you're missing out on potential business. The next slide, I want to go through some typical PI claims just to give you a flavor of what can really go wrong. I keep talking about this financial loss. So let's take the first example. We've got a SaaS company providing like tracking of data, but there's an error, and because of that, they now can't continue doing business. They've lost money. They even lose their clients. So that's a potential lawsuit. The second example is more around like a software developer example. So this company's an app developer, but there's a failure in the app and their end users are no longer able to transact. They've had to maybe they're out of business for a few days because of the failure in the app, and then they want to claim against the loss of revenue that they've incurred. So that's another type of claim. And the third one I have there is similar to what I talked about before on the 2 slides before about, if you get sued by a client for failing to protect the personal data of the end users. Again, that comes down to an error on the insured side, on the policyholder side. And that's also grounds for someone coming over and saying, hey, because of that, I've now faced a whole bunch, all their clients, they're losing all their clients because now all their personal data has been leaked, so they might come after and claim after you. I just realized there's a mistake on the slide. This is not D&O policies, but this is PI policies. What do insurers look for? They look for what you're actually doing. What is your breakdown of business activities? Are you a software developer? And what sort of software are you developing? Is it an app? Are you providing cloud infrastructure? Are you providing software, hardware? They really want to know exactly what sort of business activity you're doing. Same if you say, oh, I'm a business consultant. Okay, what sort of business consulting are you doing? Do you do recruitment as well? Or is it just purely management consulting? So insurers really want to understand what your professional service is. They also want to know how much money are you making. A lot of it is based, in terms of the pricing, is based on your revenue. Look, I know a lot of you guys on the call are probably relatively small companies, or some of you might be even like brand new. And it's really hard to say, oh, how much you're making. Even a projection of what you'll be making in the next 12 months is just really helpful. That's a really key element of what insurers look at in terms of the pricing. Then they also want to know, who are you doing business with? What sort of clients do you have? Who are your top 5 clients? Are they, the big enterprise clients? Or are they other small startups? They just want, and what sort of industry they're in. So, for example, if you're dealing with mining companies, for example, that's almost like a big red flag. That they're like, oh, mining companies, they like to sue a lot, maybe would price a little bit higher, versus if your clients are just other startups, potentially they look at that risk much easier. They always want to know, is there exposure to the US or Canada? So is your service being used in the US? Do you have clients in North America at all? And what percentage of the revenue that you're generating comes from there? So I mentioned this last time. The North America is just extremely litigious. Having exposure to North America means there will be always an increase in premium. I don't know how they do it, like what they add on, what the percentage is, but there's always a bit of an increase. Insurers, in insurance policies, there's always something called like a deductible. So the first X number of dollars, let's say $10,000 is borne by you. So they don't want to touch any small claims. Anything above, let's say $10,000, they'll start paying out up until the limit of, let's say, $1 million. When it comes to claims that originate from the US and Canada, a lot of the time they increase that deductible at least by twofold. So I've seen them like $25,000, even $50,000 that you'll need to bear by yourself upfront first before the insurance kicks in. And it's again because this, legal fees are extremely high, and legal action is just more common in the US. So they don't want to. The insurers are always trying to reduce their exposure in that way. Another thing the insurers look for or they ask about is whether you're using consultants, contractors, agents, and then they'll want to know things like, okay, if you do use them, do you ask them to have a PI policy themselves? If they have a PI policy themselves, that means if you get hit and it was a result because of one of these consultants, the insurer can always claim off their own personal PI policy. So that reduces the risk for the insurer for you. So that's something they always want to find out about. And then for tech companies, so the software type companies, they want to know what sort of risk management processes do you have in place. And it's mostly things like, what do you call it? Like cyber type questions, is your stuff securely stored? Do you have sign-off processes in place with your clients if you're a software development type company? All that kind of stuff. And if you are a tech company, who are your IT vendors? Do you use like AWS, Azure, like who's your cloud service provider? Do you use other vendors? And they just want to know that they're just a little bit more stringent when it comes to tech related companies. So there's a little bit more that you need to go through. I'd say it's pretty much straightforward if you're a business management consultant, but when there's a tech element, the insurers just really want to make sure they understand the risk and what other vendors are out there, what are the risk management procedures that are in place. So that kind of like brings me to the end of the presentation. It's quite a short one today, but I see there are some questions, so I thought maybe we could move to that. What are the costs and benefits of implementing a PI policy? Okay, so we're talking about costs. I'd say in Singapore, the minimum premium for a 1 million limit of liability of a PI policy is, the cheapest I've seen in Singapore is around $2,000. So just a heads up, that's how much it'll cost you. The benefits, well, with all insurance, it's the so-called, what do the insurance always try and say, peace of mind, right? That you've got this insurance in place. The benefits, if I can go back, is what you're covered for. If you get into a lawsuit, if you get investigated, face a fine or a penalty, the policy is there to pay for all these legal defense and settlement costs. So I'd say that's what the benefit is. The cost is $2,000. The benefit is you'd have that coverage up all the way to $1 million. So I think, yeah, that's how I look at it from a cost-benefit analysis. And again, if you are going back to my other slide about if you're trying to do business with enterprise clients, a lot of them anyway require it. It just makes you look a little bit more professional. So that's another benefit to putting a PI policy in place. Software and SaaS companies also make products to the market, yet product liability excluded from PI. Okay, so when I say product liability, a product, maybe we should do a webinar on product liability as well, if there are enough companies that make physical products that are part of this level 3 network. Product liability covers property damage and bodily injury claims. So as a software company, your products aren't going to really cause someone to be hurt, like physically hurt, or create a property damage claim. So that's what they mean by the product liability exclusion. Does PI more cover implementation, advice, service, and product liabilities for software? No, so PI is to cover your advice, your service, and your product. So if your software product fails and your clients no longer can use it, and because of that they've lost business, that's PI. It's, again, product liability is, you have to think about it as property damage and bodily injury. So, Sean, hopefully that's answered your question. The next question is, PI insurance limited to certain sectors of an industry? If a company were to, say, expand operations from one industry to another, would its PI policy no longer apply to the new sector of the company catering to this industry? Right, so I'll move back to this slide about what insurers are looking for. So it's this breakdown of business activities. And when you're, with most insurance policies, by the way, they usually go for a 1 year duration. And so when you apply for insurance, you're thinking of this 1 year, 12-month kind of time span. And you're saying, okay, in this next 12 months, this is going to be my business activity, and this is how much I'm expecting to make. If you're an already existing business, you'll need to also tell them how much revenue you've made in the past 12 months. So you tell them the past, and then you tell them what you're expecting in the next 12 months. Now, if that business industry is going to change significantly, and be interesting to, if you could give an example of one industry to another, how that would work. But if you're still a software provider that maybe was catering for, construction companies, but then that same software could be used for the medical industry. If it's the same software, I suppose it's the same type of business activity. Your business hasn't really changed that much, unless maybe your client base has changed. What happens? So maybe in terms of your question with this industry, maybe it's affecting more your clients, your top 5 clients. Maybe later in the year changes from, like I said, construction to medical type clients. I don't know. The point I'm trying to make is when you're signing this proposal form, say, okay, this is what I'm declaring for the next 12 months. This is as best as to your knowledge of where your company is at this point in time. Things will always change. And when it comes to renewal, so 12 months later, that's when you say, oh, you know what? Actually, 9 months in of the 12 months, we changed our focus and we did this instead, And then that's when the insurers basically tweak it for the next year. If there is a claim that happens, I think you should still be covered because you declared what you knew at the beginning of the year. Unless it's completely what they call like a material change to the business, extremely changed. Like you're no longer doing software. Now you're, you're no longer a SaaS provider. Now you are purely a business management consultant. Like there's no more technology element. Or you started as a traditional business consultant and now you've added a technology element. I think if there's a real material change in that type of activity business you're doing, then the onus is on you to let the insurer know that you're no longer doing what you claim to have been doing at the start of the insurance policy. So I think it really depends on what this change is and how the business changes. But in general, when you're applying for the insurance for the whole 12 months, you're declaring what you know at that start of that period. Can I add professional liability insurance to my current commercial policy? I assume when you say commercial policy, you mean like a business insurance policy, like maybe you're paying for, I don't know if you're like renting an office and you've got to pay, you're renting an office, so you've got to buy like public liability insurance in case you damage the premises for your landlord, if public liability in case someone slips and falls when they come visit you in your office. I assume that's what you mean by commercial policy. I don't see it so often in Singapore where professional indemnity, professional liability is added as a sub-cover under this whole business insurance package. It's usually a standalone, a product bought separately. It's not really lumped in with the rest of like insuring your laptops and the public liability and all that. It seems to be quite standalone here in Singapore. How does D&O and PI work where a director is also a consultant and maybe a target of a PI claim? This is a great question, Sean, and we see this sort of grey area happen quite a bit. So we always recommend, if you're in a highly regulated area as well, industry, sometimes taking out a D&O and a PI is really important because the insurer might say, well, you're a director, so it's a D&O claim versus, it's a PI. And unfortunately, insurers can be really sneaky and try and split the claim up in those kind of ways. So obviously it's more of an expense, but in some cases, especially if you're regulated in the fintech area, especially, you probably want to look into getting both because then it covers you from the both angles, from the providing the service and the error with providing the service versus the management's. It was management's liability to make sure everything was done correctly. So yeah, sometimes it works to have both. And just going back to this thing about MAS and fintechs, that's also unclear sometimes if they're coming to do an investigation. Is it because of an error, or is it because management had oversight on the tasks that were done and there was an error? So yeah, I'd say if you're in a regulated space, there's always an upside to getting both policies out. Are there any other questions that people want to raise? Just wanted to kind of, just say that, legal risks are everywhere. Last time we talked about the risks to directors, and, same with professional indemnity. It's also another legal risk. It's just good to protect yourself when you are providing services out, and there's always a chance of lawsuits, and we always think Singapore or Asia in general is not so litigious, but we know things do happen. So it's always great to protect yourself. And there's also that element of, hey, if you want to work with enterprise clients, there's that opportunity to do so. And there's a lot of the times request for you guys to get a PI policy in place. Anapi is we're a tech-enabled insurance platform, and we help startups, small businesses get insurance. I've been trying really hard to find an insurer who is willing to quote on the spot for professional indemnity for small businesses. I have yet to find one, unfortunately, at least one that's got enough comprehensive covers. So we don't have that option like we do with D&O or in cyber, where you can apply for the insurance straight online. But we do have, if you want to get in touch, I know Azra's going to send out some links afterwards so you can set up like a one-on-one session with me either tomorrow or I think on Friday. But if you already know you kind of want to get a quote in place, or you want to see what that pricing looks like for your business, you can go to our site and put in a request for a quote and we can get in touch with you. Like I said, in Singapore, we're looking around the $2,000 mark minimum, and that's $1 million limit of liability is usually the smallest that you'll be able to get in Singapore. Okay, I guess there's no other questions, so we can finish a little bit earlier. And I see, yeah, we have this link set up. And I think the timing for tomorrow is in the afternoon and Friday morning from memory. If you wanted to get in touch with me, we can just chat a little bit about your setup, your business, whether it makes sense for you to get a PI policy in place, or maybe it's something you want to hold out for a little later on. Like, we can just have a little discussion and chat about that. So Azra, shall I hand it over back to you?
Thank you for joining in. I think I'm sharing the screen for Ruth's advisory clinics for tomorrow and Friday. So if you like to have a one-on-one session with Ruth herself, you can scan the QR code or put in the link that I sent in the chat. With that, I'll close the session. Thank you so much, Ruth, and have a nice day ahead.